Most people invest randomly, but real wealth is built with structure. Eyeing what's trending, selling what's falling, and hoping for the best all lead to the same problem: random investing that rarely works. Structured wealth is the disciplined alternative that creates lasting financial success. Today, we're building a balanced portfolio designed for the 2026 market. Money Mastery is your step-by-step guide connecting financial freedom and wealth creation. I'm going to show you exactly how professionals build portfolios from zero, even in a changing market. Let's start by understanding why most portfolios fail and what separates strategic investing from pure gambling. Most investors make three critical mistakes: no plan, no diversification, and emotional decisions, all leading to portfolio failure. They chase hype during rallies, panic sell during crashes, and keep repeating this destructive cycle. A portfolio without structure is just a collection of bets. So what does a balanced portfolio actually mean, and how does it protect you across all market conditions? A balanced portfolio combines growth assets for appreciation, income assets for cash flow, defensive assets for protection, and liquidity for flexibility. You're not betting on one future. You're preparing for many. Step 1 is defining your core foundation, the long-term engine that drives wealth accumulation. Build this foundation with market ETFs, quality stocks, and equity funds that provide broad exposure. The goal here is simple: compound wealth steadily over time. Next, add stability and income to reduce volatility and generate reliable cash flow. This layer includes dividend stocks, bond funds, income ETFs, and real estate trusts that smooth out the ride. Together, they deliver steady cash flow while protecting your portfolio from excessive swings. Now add defensive protection, your seatbelt during market crashes. This layer combines gold, cash, and short-term bonds to preserve capital when markets tumble. The purpose is crash survival without panic-driven mistakes. Optionally, add growth themes to participate in innovation without betting everything. These themes include AI technology, clean energy, biotech, and digital finance, the future's emerging opportunities. This lets you participate in trends while keeping most of your portfolio safe. Here's a sample framework showing how these layers might combine in practice. Growth allocation takes about 55%, income allocation 25%, defense allocation 12%, and themes allocation 8%. Not a rule, a framework you adapt to your own situation. The secret weapon that makes this all work is rebalancing strategy. Once a year, review your portfolio, trim the winners, and add to the losers. This forces discipline and removes emotion from your investment decisions. You don't need perfect timing, you need a perfect system.
If this video helped you, show your support by hitting the like button and subscribing to the channel.
Up next, we'll dive into building your first portfolio step by step.
The goal is to reach 10 lakh rupees, or about $100,000, through strategic portfolio building. Thank you so much for watching, and I'll see you in the next video.